and welcome to the Global View on this Monday. I'm Andrew Gagan. Thanks for joining us as we get this week underway. Well, European shares ended a 4-week winning streak on Friday amid an unwinding of tech stocks and resurgent Middle East tensions. On Wall Street, S&P 500 contract futures there dropping 0.5% in early trade. That's off the back of this renewed tension we're seeing in the Middle East at the moment. Now on Friday, investors shrugged off the latest threats out of the Middle East and stocks climbed on renewed enthusiasm about the AI-related trade. All three majors on Wall Street there ending higher for the week. The S&P 500 added 1.2% to be close to a record. The Nasdaq climbing 1.7%. The Dow, though, that was off 0.5% over the 5 days. Well, the AI trade returned to the spotlight after South Korean chipmaker SK Hynix debuted on the Nasdaq, with its US-listed shares jumping 14% after the firm raised about $26.5 billion. Its US peer Micron fell, while Meta Platforms jumped 6% to its highest level since April. Moderna tumbled almost 11% in its worst day in more than a year, and Delta Airlines fell even after forecasting third quarter profit above expectations. Well, US and Iranian forces have exchanged heavy missile and drone attacks, while Iran has said it has again closed the Strait of Hormuz. US Central Command denied that, saying the waterway was still open to all vessels, and the US military is prepared to ensure freedom of navigation. The US attack was its third over the past week and has prompted a retaliatory response from Iran, which struck US allies in the Middle East, including Kuwait, Jordan and Qatar, with only minor damage and no casualties reported. On Friday, President Trump said the US would continue talks with Iran, but stated on social media that the Islamic Republic of Iran has asked us to continue talks. We've agreed to do so, but the United States has stated to them in no uncertain terms that the ceasefire is over. Well, US Treasuries slid on Friday and renewed tensions between the US and Iran, while disruptions to traffic through the Strait of Hormuz fueled concerns that rising oil prices could add to inflationary pressures. US 10-year yields, they were slightly higher at 1.56%. The curve was modestly flatter, with the 2-year yield 3 basis points higher. Australian 3-year government bond yield futures there rising to 4.44%, the 10-year at 4.89. US dollar index up around 0.5%. The Aussie is currently trading at 69.4 US cents. Well, oil prices have jumped as Iran expanded strikes on Gulf states following attacks by the United States threatening energy shipments via the Strait of Hormuz. Brent crude futures climbed 3% to $78 a barrel after rising more than 5% last week. Gold has eased over concerns of higher inflation via those higher oil prices. Spot gold at $4,120 an ounce, having lost around 1.5% last week. Copper futures are up slightly. Iron ore up 0.5% to 101 US a tonne. And Bitcoin is currently trading just under 64,000 US dollars. Well, let's now get across what we're seeing in markets. Chad Padowitz joining us from Talaria Capital to break down what he sees as a correlation problem in global financial markets. Chad, welcome back to you. So,
Thank you.
Interested then of what you're seeing in relation. You talk about the global investable assets with that meaningful correlation, particularly to the S&P 500, has risen to more than 90%. What does that tell you?
Yes, so as you said, it used to be that you could have a range of different assets and they would be not highly correlated to each other. So diversification was relatively easily achieved. But now, from about 26% correlated in 1995 to over 90% now in terms of global investable assets to the S&P, effectively the many bets you have are really just a single bet. And it's not just about equities, it actually extends across other asset classes as well, into bonds, into private equity, into REITs. So effectively, the vast majority of investable assets are really just trading very similarly, and that creates a significant issue for investors that are looking to obviously have a level of diversification.
What's behind this? Is it all about that AI trade? Everything is sort of AI is sucking all that capital in, if you like.
Yeah, well, a substantial portion is around the AI because of the market cap concentration of the mega IT names, which are linked to AI, as well as the AI specific names. You do have really a single bet on AI. and it's you're requiring not just that it's successful, but that everything that is transformative, that it works, that it actually brings the productivity that everyone's expecting, and everyone linked to it, or all the companies linked to it, make exceptionally high levels of profitability as well. So you have a substantial bet across all asset classes, really on a single transformative type technology, which is, historically most technology changes are quite disruptive, and it takes quite some time to get who wins and who loses. And already the market's applying basically 100% success rate right at the beginning. So we think there's a lot of risks that are coming from that concentration from the AI trade.
Now, Chad, in the past, if you wanted that diversification, bonds were the go-to, and because of that negative correlation we have seen with equities. Although, more recently, that hasn't worked. So, I mean, it begs the question, I guess, in terms of that balance, the 60-40 balance between equities and bonds, whether that's still applicable.
Well, it certainly hasn't been of late. So up until the 20 years, up until 2020, there was a negative correlation, which meant, if you had bonds and equities, one did well, the other one didn't do as well, and vice versa. So you were able to get a level of return from one of the other two, one of the two, sorry. But since 2020, they've become very highly correlated to around 0.6 now. And a good example of that was in 2022 when the rate shock drove the market, S&P down over 20%, I think 24.5%. The bond market was about 80% correlated to that. So certainly you're not getting the benefits of diversifying across asset classes, i.e. equities and bonds. And it's not obvious that that's going to change anytime soon.
So what's the option you have then, Chad? If that's not working for you, where can you go?
Yeah, well, one, there aren't any really easy solutions because a lot of the solutions that are very well, likely correlated or even negatively correlated are actually occupy quite a small part of a global investable assets. And they are things like, to some extent, commodities, event-driven strategies, merger arbitrage, catastrophe bonds would incorporate that. Volatility is probably one of the ones that we think is more interesting, volatility risk premium type strategies. So you need to go quite outside the conventional asset class and strategies to get that low level of correlation to achieve what you're trying to.
Are you expecting that in this current environment that this issue is likely to persist? So you need to come up with some solution.
Absolutely. Well, valuations are very high. So it's one thing if valuations were very low and we had, let's just call it, complete confidence that everything relating to AI would be successful, then it would be, well, we might have one bet going on, but it's a very good bet and a high probability one. But given valuations are high, given the correlation problem we've already discussed, and given, effectively just the high level of AI uncertainty, definitely think until those resolve themselves, then you do need to look at some of these other strategies and that I mentioned.
Well, meanwhile, Chad, you do see opportunity still, obviously, in the equity market. Let's go there because you always do bring us one stock in focus. Today it is A.O. Smith. So, this is a US water heater manufacturer.
So A.O. Smith is a US-based water heater, effectively, a water heater type business. They sell hot water systems. Housing market's quite weak in the US, but they really have about 80+% based on replacement cycle. Volumes on the lower end because of the, basically the housing market and new housing construction. But we believe that is a very strong, durable business. We think it's worth around $75 to $80 a share. It's trading at around 60 now. There's effectively no debt in the business, a very high return on capital, And we think that's the kind of company you can invest in at the moment, and that doesn't have a lot of these risks that we've spoken about.
When you look at what's going on Wall Street in particular at the moment, Chad, is it your expectation? We're talking about obviously the AI trade. Do you feel as though there is more in that? I mean, there's so much of this based on both MOMO and FOMO, if you like. How cautious are you?
Yeah, I think there's a great deal of AI uncertainty, but it's not really reflected in the valuations. So you think of things like SpaceX and the kind of valuation that got achieved relative to the size of the actual business at the moment. A whole bunch of companies are now listing onto the US, like semiconductor stocks from South Korea. They're actually chasing into the US market for lower cost of capital. So you are seeing a supply response to very high valuations. And that is telling you something. That is telling you, hey, the market's paying a lot for companies that aren't yet generating the income that should probably justify it. So let's go chase that demand for those assets, and that's creating more and more supply. So I do think it self-corrects by excess supply does bring down valuations over time as well. But we're certainly seeing a fair amount of optimism, euphoria, anything to do with effectively the AI linked type equities.
Chad, great to get across what you were seeing in markets at the moment. Thanks for joining us from Talaria Capital.
Great. Thank you. Bye-bye.
Right, let's turn our attention to the local market, but ahead of the open on this Monday. Now, that doesn't tell the full story there. So obviously SPI futures, now this is where it sort of settled on Friday, essentially up 0.5%, but has not factored in those developments we've seen over the course of the weekend with both US and Iran engaging in hostilities yet again. So we'll just beware where we're likely to start for the open in just a couple of minutes. Stay with us.